Well, I mean, we agreed that if inflation and interest rates took off, that would be a problem for high valuation stocks. But I do think what is happening now, we saw a dry run of it before COVID. So if you remember before COVID, as we realized what a problem we had on our hands, the globe had, I think the markets were down in 1 month's time 25%. We were down 46%. From those lows, as you just said, we from April 20 to 21, 350, 360%. Since then, just to keep the perspective here, down 75% at our low in May. Now we're probably testing it today as we speak, so we shall see. I think one of the things that has happened is during risk-off periods, we see a rush back into indexes. So a lot of the market's gone passive, but when we move into risk-off, this idea of career risk, business risk surfaces in discussions, and there's a movement back into benchmark stocks. We don't own the big benchmark stocks. Only one of our stocks has made it into the benchmarks, and that's Tesla. And believe it or not, Tesla's held up better than our portfolios, right? So I think there's been a lot of algorithmic trading. I felt it pre-COVID. The variables algorithms focused on cash burn, cash cushion. And yet at the time we were saying, wait a minute, this makes no sense. This is COVID, and we need to solve this problem. Innovation solves problems. And so that was one of the reasons we had that swoosh, right? We were solving problems, global digitalization, figuring out we sequence the coronavirus and so forth. I think the same thing now. We've had this incredible decline. We have so many more problems now. Supply chain, Russia's invasion of Ukraine. Innovation solves problems, and yet these algorithms and very short-term time horizons. Ours is 5 years. The market in risk-off goes to 1 quarter. Algorithms are dominating the market. It's very interesting. Most people don't know what our companies do, and they don't know the kinds of problems they are solving. But as we've gone through this period, the 75% decline, we've concentrated from 58 names to 33 names, to our highest conviction names. Typically, that's a very good strategy for the turn in the market. So you're asking about the wrapper, separately managed.
Yeah.
Okay, we do run other accounts like that. But we're very clear about what we do and what we don't do. We are not an asset allocator. We are focused exclusively on disruptive innovation, transformative innovation, and I think we're fulfilling an unmet need out there. We are doing research and giving it away to help educate people on how our world is going to transform. And I think the underlying premise in your questions, Ulrika, is that inflation is the problem and might remain the problem. We actually think there are signs all around the world that deflation will be the bigger problem. And as I understand from this conference, I don't think the word deflation has been mentioned here. So I kind of like that. If everybody is sure something's happening and you have evidence brewing that might not be true, those are great calls. Now, I have a macro background. If I were running a macro fund, I think it would have done pretty well this year, but that's not what we do. We do have a point of view, though, on deflation from two angles. Cyclical, in the pipeline, commodity deflation is proliferating, and then downstream at the consumer end, and this is globally, we are being overwhelmed by inventories. So we believe in this holiday season that will become clear. It was interesting to see the online expectations for this holiday season, only 2.5%. That doesn't allow much room for real growth or inflation, right? Something's wrong out there, number one. And then the other thing is innovation, especially the amount of innovation that is evolving today, is inherently deflationary.